Good morning, everyone. Well, Friday's market action was purely technical. If anything, the news was dollar positive after the third quarter U.S. GDP figures were revised up yet again to 4.1% quarter on quarter on stronger results for consumption and business investment, which is great. Yet long-term bond yields peaked shortly after the release, and the dollar declined with them during the day, even though the implied interest rate on Fed funds futures continued to rise. Stocks seem to be doing much better than the dollar in this post-tapering world. The main action Friday was in dollar Canada. It initially rose to a high for the year on below forecast inflation figures for Canada for November. However, there is apparently considerable end-year demand for Canadian dollars, and the pair actually managed to close lower on the day. The range for the day was 1%, which is extraordinary, considering the range for the whole year has been 9.4%. Australian dollar was the biggest gainer on the day. Market participants were apparently impressed on Friday that Aussie dollar failed to make a new low, even though it was the 9th consecutive daily fall in Chinese stocks. With the Chinese market recovering somewhat today, Aussie dollar recovered further with it. The move seems to be mostly due to the closing of short Aussie dollar positions, though, ahead of the holidays, rather than any big change in view about Australia. Now, with the Christmas holidays this week, I expect activity to be quite thin and movements to be much more technical than fundamental. Now, in this kind of a thin market, prices can be either quite dull, deadly dull, or they can be quite volatile. In 2007, the week of Christmas was tied for the second highest volatility week of the year. In 2008, it was the most volatile week of the year. But in 2011, it was in the bottom 20%. In 2012, it was the fifth quietest week of the year. For today, the main indicator will be U.S. personal income and expenditure figures for November. They're both expected to show solid rises of 0.5% month on month. Meanwhile, the personal consumption expenditure deflator, the Fed's preferred inflation gauge, is expected to rise 0.9% year on year. That's a faster pace than 0.7% in October. It's still well below the Fed's 2% target, but it's going in the right direction. The U of Michigan consumer confidence figure for December is also expected to be revised up slightly. This kind of strong data should support the dollar, but if Friday's GDP figures didn't, this might not either. It all depends on whether people are squaring their positions. In Canada, we've got October GDP coming out. It's forecast to slow to plus 0.2% month on month from plus 0.3% in September. Again, in theory, that should send the Canadian dollar lower, especially after the inflation figures. Although, given the sharp rebound on Friday, I wouldn't bet on such a move lasting very long. Otherwise, there's little on the schedule, no speakers. I expect a quiet day of pre-holiday trading. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.